already introduced an NIM earlier. Now let's go slightly deeper. NIM tells you how efficiently a bank earns interest from its assets. The formula is simple. NIM equals interest earned minus interest paid divided by average earning assets. Average earning assets means the average value of loans and investments that generate interest during the year. If a bank has higher NIM, it means it earns more from each rupee of lending. For example, if NIM is 3%, it means for every 100 rupees of earning assets, the bank earns 3 rupees as net interest income. Higher NIM usually indicates strong pricing power, low cost of funds, efficient asset mix. Now let's compare two types of banks. Let's take a typical example. A strong private bank may have NIM around 4%. A typical PSU bank may operate around 2.5%. Why does this gap exist? Private banks usually have higher CASA deposits, better retail loan mix, stronger underwriting. PSU banks often have priority sector obligations, higher funding costs, legacy asset quality stress. As an investor, don't just look at the number. Ask, why is this bank's NIM higher or lower? Now let's understand trend interpretation. 1 year of NIM data is not enough. You must track the trend. If NIM is rising consistently, it signals improving profitability. If NIM is falling, it may signal deposit cost pressure, competitive loan pricing, asset quality issues. NIM is closely linked with CASA. And that brings us to the next important ratio. CASA stands for current account plus savings account. These deposits are very important because they are the cheapest source of funds. Savings accounts may pay 3 to 4%. Current accounts usually pay zero interest. Compare that to fixed deposits, which may cost 6 to 7%. So if a bank has higher CASA ratio, its cost of funds is lower. Formula: CASA ratio equals current plus savings deposits divided by total deposits multiplied by 100. Higher CASA generally supports better NIM. Now let's see how this affects profitability. Let's compare two banks. Both have 100 crore rupees in deposits. Bank A has 60% CASA, Bank B has 30% CASA. If CASA costs 2% and fixed deposits cost 6%, Bank A will pay much less interest overall. Lower funding cost means higher net interest income. That's why strong CASA franchises create a long-term advantage. Now, let's connect CASA and NIM directly. Higher CASA leads to lower cost of funds. Lower cost of funds improves NIM. Improved NIM boosts net interest income. Higher NII improves profitability. So CASA is not just a deposit metric, it is a profitability driver. Now, let's move to efficiency. Return on assets. ROA tells you how efficiently a bank uses its assets to generate profit. Formula: ROA equals net profit divided by total assets multiplied by 100. If ROA is 1%, it means for every 100 rupees of assets, the bank earns 1 rupee in profit. For banks, ROA above 1% is generally considered healthy. Top private banks may operate at 1.5% or higher. Lower ROA may indicate weak margins, high provisions, operational inefficiency. Now let's understand why ROA matters. Banks operate with very large balance sheets. Small differences in efficiency make big differences in profits. ROA measures how well the entire balance sheet is being managed. ROA is different from ROE. ROA measures asset efficiency. ROE measures shareholder return. Both are important, but they tell different stories. Now let's connect ROA with other metrics. ROA improves when NIM improves, CASA improves, NPS decline. Operating costs are controlled. Lower NPS mean lower provisions. Lower provisions mean higher net profit. Higher net profit improves ROA. So asset quality, deposit quality, and cost efficiency all influence ROA. Now let's compare across bank types. Private banks generally report higher ROA, often above 1.2 or 1.5%. PSU banks may operate below 1%, especially during stress periods. Why? Better risk management, better technology adoption, better cost control. But remember, always compare within the same economic cycle. Now we move to a very important ratio, return on equity. ROE tells you how much profit the bank generates from shareholder capital. Formula: ROE equals net profit divided by shareholders' equity multiplied by 100. If your ROE is 15%, it means for every 100 rupees invested by shareholders, the bank earns 15 rupees per year. Healthy ROE for banks is typically 15% or higher. Top quartile banks may operate at 18 to 20%. Lower ROE may signal weak profitability or inefficient capital usage. Now let's understand capital safety. CAR measures how strong the bank's capital cushion is. Formula: CAR equals capital divided by risk-weighted assets multiplied by 100. RBI requires minimum CAR of 11.5%. Higher CAR means better ability to absorb losses. Look for banks with CAR above 14% for comfort. CAR protects depositors and it protects shareholders. Now we move to the final section, valuation and investment decision making. Now let's answer an important question. Why do private banks usually trade at higher valuations? There are a few clear reasons. First, better risk management. Private banks usually follow stricter credit appraisal processes. Second, lower NPAs. Cleaner loan books mean more predictable earnings. Third, stronger profitability. Many private banks deliver ROE between 15 and 20%. Fourth, professional management and faster decision making. Fifth, technology leadership. Better digital platforms improve customer experience and efficiency. Because of all this, earnings tend to be more consistent and predictable, and investors are willing to pay a premium for consistency and quality. Now let's flip the question. PSU banks often trade at lower valuations, but low valuation does not always mean cheap. There are reasons behind it. Government ownership can influence lending decisions. Priority sector requirements may impact profitability. Historically, PSU banks have faced higher NPAs. Operational efficiency may be lower due to larger branch networks and legacy systems. So, when a PSU bank trades at a low price to book, it may reflect uncertainty about future earnings. Important lesson here: a low stock price is not automatically a bargain. Quality matters more than valuation alone. Now, let's understand how banks are actually valued. Banks are usually valued using the price to book ratio. PB compares market price to the book value of the bank. Formula: PB equals market price per share divided by book value per share. Why PB instead of PE? Because banks hold financial assets like loans, not factories or machinery. Book value is very meaningful for banks. Book value is simply total assets minus total liabilities. Now let's see how to interpret this ratio. PB by itself does not tell the full story. A bank trading at 0.8 times book may look cheap, but if ROE is weak and NPAs are high, the valuation may be justified. On the other hand, a bank trading at 2 times book may still be attractive if ROE is high and stable. So always link PB with ROE, asset quality, growth, consistency. Valuation without fundamentals is incomplete. Now let's see how to compare banks properly. When comparing banks, don't ask which bank is cheaper. Ask which bank deserves a higher valuation. Compare ROE, ROA, NEM. CASA NPA and NNPA higher quality banks usually deserve higher PB multiples. Lower quality banks should trade at discounts. Now let's look at a practical example. Imagine two banks. Bank A has ROE of 18%, low NPS, strong CASA. Bank B has ROE of 9%, higher NPS, weaker deposit franchise. Even if Bank B trades at lower PB, if Bank A may still be the better investment because quality compounds over time. Now let's create a simple framework for beginners. Use a simple 4-step approach. Step 1, asset quality, check GNPA, NNPA, and fresh slippages. Step 2, profitability, check NIM, ROA, and ROE. Step 3, deposit strength, check CASA ratio and deposit growth. Step 4, valuation, check PB and compare with ROE. Keep the analysis structured. Avoid random decision making. Now let's talk about common mistakes. One common mistake is buying a bank stock just because it looks cheap. Low valuation often reflects deeper problems. Another mistake is ignoring asset quality or focusing only on growth without checking risk. Remember, in banking, risk management is everything. Now let's wrap up the session. Let's summarize what we've learned. Banks are central to the economy. Banks earn through interest income and non-interest income. RBI tools like repo rate, CRR, and SLR control liquidity and lending in the system. For investors, asset quality metrics like NPAs and PCR are critical. Profitability is measured through NII, NIM, ROA, and ROE. Capital strength is tracked through CAR, and valuation is usually anchored in PB, interpreted through ROE, and overall business quality. If you analyze banks using this framework, you will avoid most of the common mistakes investors make. And this is exactly how serious investors start understanding sectors, by learning how the business actually works, not just following stock tips. In the next module, we'll break down another important sector of the market and understand how that industry really works. So if you want to build real clarity about the stock market, make sure you stay tuned and subscribe to the channel.